Hello, welcome in the next video and the next unit also. In this unit, we will talk about what is liquidity and how can we actually use liquidity. Okay, let's see the definition first. If smart money or banks want to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called the liquidity. The liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. Smart money needs to activate the stop losses of the existing orders in the market so that they can place their positions in the market. Okay, let's see some examples for this. Okay, so our first type of liquidity are the equal highs and the equal lows. The names speak for themselves. Price will form equal lows when the low points are on the same level, and also price will form equal highs when the highs are on the same level. We have two types of equal lows and two types of equal highs. Okay, let's see an example for the equal lows. On the first example, price is moving in a left and creating a series of higher highs and higher lows. After the high has been created, the first high has been created, price did a pullback, but didn't tap into a demand zone. Instead of tapping into a demand zone, it created a low. And after the low has been created, it couldn't break above the last high, and it created another pullback. After this pullback has been created, the price couldn't break below the pullback phase low, so this low point, and instead of breaking below this low point and tapping into a demand zone, it created the second bottom. So this means we have a liquidity line here, which is perfectly equally lined up, and after this, price created a new high. What can we do in this scenario? Price has a great chance to come back to this demand zone and mitigate the demand zone which has liquidity above, and sweep all of the liquidity from this region, because you have to think with the retail trader's brain. So the retail traders usually open on the double bottoms and the triple bottoms. So if they say a double bottom, they will open a buy position here. So the purpose of the smart money is to sweep all of the retail traders' stop losses, and you want to enter after the stop losses have been swept. So retail traders open a position here. They will place their stop losses on this line, but you have a demand zone right here, and you know that a lot of retail traders open the position on this line, and they have stop losses here. So you will wait for this zone to be tapped, and after the sweep of the liquidity and this zone tap happened, you can easily hop into a position and enter in a long trade, because the market collected the retail trader stop losses. So there's no more stop losses needs to be collected. So after the purge or the liquidity sweep, you can easily hop in a trade. Okay, the same scenario happens with the triple bottoms. The difference is only that price creates triple bottoms, of course. So it created the first, second, and third bottom. After it created a new high, but you have the same concept. Retail traders opened on this line. So a lot of positions opened on this line. A lot of stop losses were placed in here, trillions and trillions of dollars and sitting on this line. So market will need to sweep all of those trillions and trillions of dollars and stop losses in order to continue the overall trend, which is bullish in this case. So after the liquidity sweep, price will tap into this zone. And after the sweep and the tap, you can easily hop in a trade. The same scenario happens with the equal highs, the double taps and the triple taps. The only difference is that it's formed on the upside and not on the downside. So price created a downside movement, pullback, created the first tap, little pullback again, created the second tap, equally lined up taps. After this, price will create a new structural high. After this, price will come back and tap into a supply zone, sweep all of the retail traders stop losses. Retail traders sell here, as you know. And yeah, that's basically all. You have a triple taps also, which is the same as the triple bottoms. Just on the other side, on the seller side, market will sweep all of the liquidity from this region too, tap into this supply zone, and after you can hop in a trade easily. Because the main purpose of the smart money is to always enter after the retail trader stop losses have been swept and taken out. So you only want to enter after the stop losses have been swept. This is a really, really, really strong confirmation in smart money concepts and supply and demand trading. Okay, let's hop into the next scenario. Okay, that's your second type of liquidity, which is the trend line liquidity. We have the same scenario. Price is moving in an uptrend, creating series of higher highs and higher lows. Price mitigated this demand zone here. After this, created an inefficient push to the upside. Let's say swept the liquidity from this region because we had a double taps here. So it swept the liquidity and broke structure to the upside with this movement. So it has all the three criteria. So this is a really valuable demand zone. Price arrived in this phase with a pullback. And after the pullback, price started to form small, efficient movements to the upside, small little break of structures, zero liquidity sweep. So the only criteria here is the break of structures, but those movements are really, really slow and choppy, and we do not like them. So if price turns into this phase, we will call this a liquidity trend line, because price is breaking structures to the upside slowly, creating some new highs, new lows, new highs, new lows, and these new highs and new lows will form a trend line, because retail traders call this a trend line, and they will open their positions on the trend line touches. So every time price touches this trend line, they will open a buy position here. So let's say they open the buy position here, they place their stop loss here, open the buy position here, stop loss here, opened here, stop loss here. So we have a lot of stop losses just above each other on this line. So we have really loads of stop losses sitting just below this line placed by the retail traders. So if you see something like this, and we have a really valid demand zone below the stop losses, so below this line, for example, this one, because it had all the three criteria, we will wait for this zone to be tapped and wait for the liquidity purge and the liquidity sweep. So price has a really great chance to sweep all of the liquidity from the retail traders, collect the liquidity, tap into this valuable zone, and after it tapped into this zone and swept the liquidity, you can easily happily long trade here after the liquidity has been collected, because as I said, the main purpose of the smart money is to enter only after the liquidity has been swept on the retail side. So you only want to enter if you know that the liquidity has been collected. If price sweeps this liquidity trend line, you can easily happily trade here and enter on the long side of the market. So once again, on the sell side, price created this valuable supply zone because let's say it swept liquidity from this region, swept double bottoms. It created inefficient move, broke structure, so it has all the three criteria, and it started to form small break of structures to the downside over and over again. If we say something like this, it's the same like on the buy side, because price creates a small break of structures to the downside, so retail traders enter on the trend line touches, so place their stop losses just above the entered positions. So we have loads of liquidity sitting on this line again. We will want to wait for the sweep of this liquidity and tap of this valuable zone, because just think about it logically. We have liquidity, it has to be swept. We have inefficiency, it has to be filled. We have order block or supply zone, it has to be tapped. So this is a really strong confirmation, because we basically can predict the direction of the market. We can predict that price will tap into this zone, sweep the liquidity, fill up the inefficiency, and collect the orders from the zone. So yeah, after the liquidity have been swept, you can wait for a tap of this zone, and you can enter in a sell position after all of these stop losses have been swept. So yeah, let's hop into the next one.